Hi, my name is H. Shah. I am from the IIM Mumbai MBA cohort 27. I am here with our mid-sem paper of module 1 for the subject of financial reporting and analysis. So let's quickly hop into it. The question number 1, which says that we need to explain the structure of balance sheet using the basic accounting equation, which is that asset is equals to liability plus equity. So basic structure of balance sheet is, here comes the asset and here comes the liabilities and equities. Here there is two parts, non-current asset and current asset. Along with that, here is equity, non-current liabilities and current liabilities. Now it is also asked, and here is the A part, here is the B part. A will equal to match. That is our next question. That why it always tells it is because of the dual aspect concept, which says that every expense has to be needed to be, and if you are expensing, if you are purchasing some goods, so goods will be the asset and the expenditure will be shown in the income statement, which will come in the liability section. Fine. Now let's quickly hop to the second question, the B part, which is asking us to calculate the COGS, which is the cost of goods sold. Basic formula for COGS is the changing inventory plus the purchases made. The changing inventory is the opening inventory minus the closing inventory. As simple as that. Now it is asked that what is the application of matching concept. Matching concept says that whatever revenue you are doing in return of the expenditure needs to be accounted in the current year only. So for the expenditure needs to be accounted and the revenue for the current year. Now let's go to the second question. Now for the second question, here the total is 35500 and 35500. This is a trial balance, typical trial balance, where the debit side and the credit side will always tally. That's how the trial balance is made. Now with the trial balance, it is asked to go with the to make the income statement and balance sheet, which goes side by side. Here I will quickly say which are the incomes which will go in the income statement and the balance sheet. Also, the income statement has two parts, which is the income generated, also the revenue, or the expenditure and the expenditure. Two parts, and also in the balance sheet there are two parts, which is the assets and the liability section. So after this all going into the respective columns, the one thing is given in the trial balance, and it is known that anything which is added after the trial balance needs to be accounted two times. Goes with the dual, because this is tallied. If we are adding this at one place, the balance sheet won't tally. So this will go in the income part also, and also the asset, because it will be used in the upcoming year. Now next question, it is related to the inventory valuation, where we need to use the method which is called the FIFO. FIFO means that whatever stock is coming in the first will go out in the first only, and after the upcoming stocks. So here it is asked for to calculate for the each variety. First variety will easily calculate using this. This inventory will go first, and then the variety 3. For variety 3, there is one thing is asked, that market competition, this price is changed. So the selling cost is increased. So according to that, we need to change, and we need to find the closing inventory valuation. It is very simple mathematics only. Now here sorry, here everything is given in the fourth question. Just this is a typical ratio question, where we need to find the ratios, which are very important. Ratios hold very important part in the accounting, where the ratios will say whether a company is performing good or bad. So here we are asked with two ratios to find, which is the current ratio and the inventory turnover ratio. The formulas is very simple. The current ratio is current assets upon the current liabilities. Simple as it will come to this year by this. And next is asked the inventory turnover ratio, which will be basically the COGS upon the average inventory. Here only inventory is given for the 31st March, so that is only the average inventory. So we'll typically divide 3200 by 600, and that's how the COGS will, the inventory turnover ratio will be calculated. Next, the last question here is a contract accounting question. In what happens in contract, there are two methods. First is the percentage completion method, and second is the uh, start at the end, where you calculate, where you recognize the revenue at the end of the after the contract is completed. So here it is given that Hiranandani Builders have taken a contract started in April 2023 and completed in June 2024. Now we need to realize the revenue at the end of 31st March, which is the completion is 80%. So the construction over 80% is completed in the at the end of the 2023 year, so financial year, and that's how we'll calculate, which is simple, again simple equations. Yeah, and that's how we need to just at the end answer that which is the better option to follow here, the percentage completion or the direct final entry. Thank you.